Salim, how are you? This is Adrian. Okay, so after our conversation the other day, I know you're asking a lot of questions regarding options, option trades, etc. I thought I'd just whip up a real quick presentation so you can have an idea of just some basics regarding options. Not too in-depth stuff. A lot of these option guys, they operate on an entirely different plane in terms of how they think, how they manage risk, which is really what you're using these tools for. and I have to say that they think in a manner that is one that is not like everybody else, just because they're so out there when it comes to understanding different option strategies. But for this little presentation, it's just the basics. Now, I have to lay a little disclaimer out here. It's obviously only for informational purposes. It's not intended to be used as a suggestion to or recommendation to execute a trade. Uh, this type and style of trading does carry a type of risk because of the complexity of the actual trades that are placed. And it's in everybody's best interest to make sure you have a thorough understanding of the actual risk parameters before executing a trade. And the risk itself can be inclusive of your entire principal, your initial investment, as well as if it goes really sideways, depending what type of strategy you would use, you'd have to come to the table with money to make good. So, if you're uncertain of the risk of the process, make sure you source out an investment professional who's familiar with options and option strategies. And then what's described in this presentation is clearly not exhaustive. And to that end, again, it's one of those where you have to source out a professional to be able to source out more information. All right, so when we talked the other day, options give you the right, but not the obligation to execute a trade, and that's important because when you look at futures trading and you look at stock trading, and also you have options on different products, you have an obligation when you're in a futures trade, right? You say, I'm going to meet on a certain day, certain time, and I'm going to bring you 10,000 bushels of beans because you've bought this price, and they dump it on your front yard fictitiously. It actually gets stored in a silo. But with options, it's just the right. So basically, you're buying the right to execute a trade. I'm buying the right for $500, $5,000 to purchase a C7 Corvette for $70,000. And as the price of Corvettes go up, my option becomes more valuable. And as the price of Corvettes come down because GM intervenes and says that they're going to spank dealerships, my option price will go back down. Now, options can both be bought or sold. They're generally referred to as calls or puts. A call, like you're calling something away from somebody else. Think of it in terms of you're buying them, you're bringing something in, you're bringing your arms to you. Puts, you're putting something on the shelf, you're putting it away. That's a sell. People who write options are, when you look at whether it's puts or calls, they are called writers. You can be a put writer or a call writer. And they have a finite amount of time and there's an expiration date. And when you look at option expiration, there's a thing called time decay where depending upon if you're a writer or not, the value of your option will actually decrease over time due to what's called time decay. So some of the characteristics, there's a strike price at which you can execute the trade, and you want to buy Amazon for $2,000. That's your strike price. And you have a strike price, you have the actual price of the option itself, which lends itself to a break even, or you're in the money or out of the money. And then you have an expiration date as noted earlier and a time decay as noted earlier. So when you own an option, for example, Amazon, it gives the person a right to buy Amazon, especially if you're looking at Amazon call options. Amazon put options gives the person the right to sell Amazon. So when you look at one option is usually a predetermined number of shares or bushels of beans or contracts of the underlying, meaning you have 100 shares of Intel, 100 shares of Amazon that are controlled by your one option that you hold. Now, when you look at like a February 22 call option, which means that that option expires this month, it provides the owner the right to purchase 100 shares of Amazon. So that call option gives you the right to actually purchase Amazon at a predetermined price. And you can buy options at any number of different price levels. And that execution price, as you'll see, varies. And there's a price component per option that changes based upon the execution price. So the actual price you're paying is referred to as the premium for the option, and it's dependent upon a number of things. As I mentioned earlier, when you have the strike price of the actual option, you're going to buy an Amazon call option for $2,000. That's going to be vastly different than an Amazon call option for $3,000. And then if you're buying a call option for $2,000 on a February execution date, that's going to be different than if you're looking at a September execution date. So there's a pricing component that plays into that based on the price of the underlying that you're agreeing to, and then also the date that you're agreeing to. And this is just taken from this website, real easy to find. I mean, I just Googled this up for simplicity's sake. So when you look at this, all the options expire on the 4th of February, and this is the strike price. And when you look at this, you can query this by either call options or put options. So meaning you're a buyer or a seller, and this would be the strike price. And you can see it's 880, 875, 870, and as that price changes, the actual option premium price changes as well. And these are call options. So if you went in and queried this, you'd see with puts, this price component would be different based off of these strike prices. All right, so your option price will change if it's a put or a call, and it will change depending on where you are. Now, one strategy that's utilized by people is, for example, out of the money call option. So here you have a call option. If we go back one screen, you can see the strike price is 28.80, which is darn close to where it is right now. And you have 28.80, but if you buy a call option, meaning you want to buy or execute your option to buy your shares of Amazon at 48.50, you can do so for just a hair over 2 cents a piece. And there's quirky anomalies where you'll see this where just randomly you have 0.023, 0.023, and here's a 0.014. I mean, I'd be all over this as an option trader because the dollar amount, who cares? I mean, you're talking $50 difference here, you're talking $50 difference here, but you can get it on the cheap, right? So you can buy all maybe 30% more options and hold on to and profit from 30% more options if you're on the right side. So now here's the thing, and here's what happens. When Amazon goes up, remember, if you're a call purchaser, you're buying a call option, you think it's going up. So if you're buying a call option for $28.80 today and it goes up to $3,000, you know your call option is worth money because you can execute a trade at $28.80 and then immediately sell them, right, at $3,000. And you can make your money on that difference, or you can make your money just on the option itself and sell the option. The other side of this is when you have far out of the money options and you look at this, what happens is there's a greater and different sensitivity to change for these guys that are further out, both price-wise as well as time-wise. And so an option strategy that you'll see many times is people will buy out of the money call options, or they'll buy out of the money put options, whether they're bullish or bearish. And what they'll do is when the price goes from $28.80 to $3,000 to $3,200, there's a sensitivity component here that's a little bit greater because you can see there's only 21 contracts of open interest, 147 contracts of open interest, and there's really not much volume that's going on here. So any trade that comes in here will affect the pricing to a greater degree, right? It'll have a greater sensitivity to the underlying. So if Amazon goes up $1, you can look at it and go, okay, is my option going to go up $1? Is my option going to go up 10 cents? So there's a ratio you can come up with for the sensitivity. The big thing I wanted to get across was when you look at the out of the money call options, you can see how the pricing for the actual stock goes up on the strike price. And now these are all staying the same because it reaches a point of finite, right? There's a finite amount in terms of how far this will drop relative to this. And long story short, when you're doing options, this is one strategy that, I mean, I've known people who've done well with this, and I've known people who've done well with regular option strategies. So just we look at the difference between puts and calls. By the time of writing this, you had Amazon was trading at roughly about $28.80. The option premium is about $80. So that means your break even is $29.60. So anytime Amazon goes over 29.60, you know you are in the money. If it's at 29.60, you are at the money. If the stock, in this case Amazon, drops below 26 or 29.60, it's considered out of the money. And so also the price of your option will go down. So you spend 80 bucks on an option premium, well, your option premium will probably go to 79, 78, 77 as the price of Amazon drops from 28.80 to 28.60 to 28.50, etc. Conversely, if we just look at this real quick, you have a put, which is a bearish strategy. Its current price is 28.80, and just for simplicity's sake, let's just say the option premium is 80 bucks. Same thing, you know that you're at the money, and you're selling that, so you know anything below you're at the money price, you're making money. Anything that goes above that, you're going to lose money on your option. Okay. Now, if we go ahead and look at this, I would urge you to take the time to just look out and look for Greeks. And the Greeks, the main ones, there's also a second order to Greeks as well, but the main ones you want to look at are delta, theta, gamma, vega, rho, and they deal with time sensitivity, actual rate of change. You have rate of change to the underlying, and you have rate of the ratio of those two, and the sensitivity to the change of the underlying. And those are all outlined here. And what I did is I just grabbed from Investopedia the ability to go ahead and reach out and take a look real quick. And so they give you an idea of the amount of change and also the magnitude of change in an option. And the guys that do option trading, those guys have themselves wrapped around that at such an unbelievable level that they can literally look at the delta of one particular underlying, have it relate and correlate to another underlying, perhaps in the same industry, and they can tell you the rest of the data points, theta, gamma, vega, rho, for the options. And there are many people who just play gamma or rho, or they trade off of theta, or they do a combination thereof. So again, I can't stress this enough. Options are a complex beast. And the other day when we were just talking through stuff, and I mentioned you can be a writer, which has unlimited risk, or you can be a purchaser of calls or puts where you know your risk is defined just to the premium itself. And that's the simplest way to start out. Thereafter, you get into things like butterflies and iron condors, etc., that are option spreads that are based off of both vertical and horizontal spreads, whether it's a calendar spread where you're looking at the different execution months, or even within an execution month, a vertical spread where you have the different prices. So there are different strategies there as well, but the easiest was the one I outlined earlier. I hope that helped. And again, if you have further questions, I mean, I'll be happy to kind of limp through that process with you. But if you're really super interested about option trading, I would definitely seek out and try to gather more information so you can be a well-informed investor. All right, bud, have a good one. Thank you so much. Bye.